So it is related to the case study on foreign exchange. So let's solve this case study based upon the foreign exchange itself. It says the forex dealer of ABC Bank sold the GBP 50,000 at 92.6875 in a cover of import by one of its branches. So it means the case that there is an import by one of its branches, and for the keeping that particular thing in mind, they have sold the 50,000 Great Britain pound. And further, later it was noticed that the transaction has been reported twice. So inadvertently, they have sold the GBP 50,000 multiplied by 2 times. That is, they have just sold 1 lakh of the GBPs, whereas they were to solve 50,000 of the GBPs. Okay, so that is a issue over there, and that is to be cancelled. And that particular sale is to be cancelled. And now, how the sale is being cancelled? That they will be purchasing the exact amount of the GBPs. They will be purchasing the exact amount of the GBPs. So here is a scenario that bank ABC is over here, and further they were to sell the 50,000 USDs, 50,000 GBPs that they sold, and inadvertently they sold 2 times. They sold 2 times. And now these are basically related to what condition? It is related to oversold situation. It is related to the oversold situation, and further so as to counter this situation, they will be cancelling the sale contract. How they can do cancel it? They can do cancel it by buying 50,000 of the USDs, by buying 50,000 of the GBPs. Okay, so that is a concept related to it. Further, it is said the interbank rate at the time of cancellation was given to be 92.6125/6575. 1 month forward rate is given over there. Brokerage is rupees 1000 for each of the sale and purchase transaction. Brokerage of rupees 1000 is basically applicable on each and every sale and purchase transaction, and based upon that we need to solve the questions. So first question over here, it says what is the amount received in original sale transaction by the dealer? What is the amount received in original sale transaction by the dealer? So what amount would have been received by the dealer in the first scenario where they have sold the GBPs? So it is clearly mentioned over there that they have sold the GBPs at what price? They have sold the GBPs at 92.6875. At 92.6875. So INR must be credited to their account. And how much GBPs they have sold? Inadvertently, they have sold 1 lakh GBPs. They have sold 1 lakh GBPs. Okay, so this is the calculation. That is the amount that they must have received. The amount that they must have received, that will be equal to 50,000 into 2 multiplied by this particular price. Okay, so it would be coming around what? So what would be the answer? So what would be the answer related to this particular transaction? So it is 92.6875 multiplied by 1 lakh, and that is equal to 9268750. 9268750. That is the answer over here. But is it so? No, this is not the case. First of all, we must understand what type of transaction it is. So is it a telegraphic transfer transaction, or it is a bills transaction? Definitely there is no differences in the settlement date, so it will be what? It will be the TT transaction, that is a telegraphic transfer transaction. And what kind of transaction, TT transaction, it will be? Would it be the buy transaction or the selling transaction? Would it be the buy transaction or the sell transaction? Can you please do answer at the earliest? What transaction it would have been? The buying transaction or the selling transaction? Buying transaction or selling transaction? What rate must have been quoted when you are to sell in the market? Let us suppose XYZ Bank as a customer. Let us suppose XYZ Bank as a customer, and XYZ want to sell in the market. At what price it will be able to sell? The price at which the market is ready to buy. The price at which, if it want to sell, it will be able to sell at a price at which market is ready to buy. So it will be the TT buying rate that shall be quoted. It will be the TT buying rate that shall be quoted. And what is the formula related to TT buying rate? The margin or the brokerage is to be subtracted or to be added up. It is to be subtracted or added up. In case of buying rates, the margin is to be subtracted. Over here, the brokerage is given to be rupees 1000. So it must be subtracted when the amount is paid. And how many transactions these are? These are 2 transactions. So minus 1000 into 2. Minus 1000 into 2. So 2000 rupees will be deducted. So 2000 over here will be deducted. So 9268750 minus 2000, that is equal to 9266750. This amount must have been This amount must have been credited to the account of the ABC bank. Is that clear? So question was, what is the amount received in original sale transaction? So the original sale was related to selling of the GBPs. 50,000 GBPs were to be sold, but that was reflected twice. It means the 50, instead of 50,000, 1 lakh GBPs were sold. 1 lakh GBPs were sold, and there were two transactions related to it. There were two transactions related to it, and further the price is given to be 92.6875. Now just think of it from the point of view that the bank is acting as a customer. The bank is acting as a customer, and they want to sell the GBPs. So what rate shall be quoted? It will be the buying rate that shall be quoted. So what rate would be applicable? It will be the buying rate that will be applicable. That is a TT buying rate that will be applicable. And in the case of the buying rate, the margin is to be subtracted. That is why we just subtracted 1,000 rupees. Why it is multiplied by 2? Because there were two transactions. Okay, so that is why 2,000 rupees are to be subtracted. So that would be the answer related to the first question over here. Okay, now let's move to the next question. Question number 2 over here. So what rate would be applied for cancellation? What rate would be applied for cancellation? It is clearly given that the interbank rate at the time of cancellation is given to be what? It is given to be that 1 GBP is equal to 92.6125 slash 6575. So this is the buying rate, this is the selling rate, and this is at the time of cancellation. I already told the scenario that they have oversold the GBPs, and how they will be setting up this transaction, how they will be just cancelling this transaction by buying the GBPs. Now if the bank wants to buy the GBPs, at what price they will be able to buy? They will be able to buy the GBPs at a price at which the market is ready to sell. And this is what type of transaction? It is TT selling transaction. It is a TT selling transaction. Why TT? Because there is no settlement date difference. Because at the time that you're ready to purchase, you will be just paying the amount and the market will be settling the amount itself. Okay, so that is a scenario. So what rate shall be quoted? It is a selling rate that shall be quoted. It is a selling rate that shall be quoted because I want to buy. Being a bank, I want to buy. So to me, so what rate shall be quoted? It will be the buying rate. It will be the selling rate, because if I want to buy, I'll be quoted a price at which the market is ready to sell. Okay, so over here 92.6575, this price shall be quoted. 92.6575, this price shall be quoted. And how many units of GBPs I want to buy? This is 50,000 units of the GBPs we wish to buy. So this is 50,000 units of the GBPs that we wish to buy. So the amount is 92.6575. 92.6575 multiplied by 50,000. So this is the amount we wish to buy. So that amounts to 4632875. But let me remind you, it is the case of the selling. It is a case of the selling. So in the case of the selling, the brokerage must be added or must be subtracted. In that case, the brokerage must be added up. So 1,000 rupees will be added up to this. 1,000 rupees will be added up to this. Okay, so in that case, what amount to be paid? Rupees 1,000 will be added up. So 4633875. This amount is to be paid. This amount is to be paid. Is that clear? This amount is to be paid. Now here is a question which is asked by someone over here that is related to, as a customer, we will be buying at a buying rate. So let me tell you, in the case of the interbank transactions, when you are selling or purchasing, as a bank, then it is related to what? It is related to the interbank rate. It is related to the interbank rate. But over here, the bank itself is acting as a customer. Just look at the narration of the question over here. That says that the bank wants to buy or the bank wants to sell. Now at what price one would be able to sell or buy? At a price at which the market is ready to sell. Okay, is that particular part clear over here? And that would be the answer related to question number 2. So what rate shall be applied for cancellation? What rate shall be applied for cancellation? It will be the TT selling rate that shall be applied for the calculation. That is 92.6575. 92.6575. Why we added up the brokerage? I just told you that it is a selling rate. In that case, you need to add up the exchange margin. The exchange margin is to be added up. Okay, you must be remembering, in the case of all the selling transaction, the margin is to be added up. In the case of the buying transaction, the margin is to be subtracted. Okay. So over here, the margin will be what? Margin will be added up. So what is the amount that is paid? It is 4,633,875 is the amount that is paid. That is paid over here. Okay. Now let's move to the next question. Question number 3 over here. It says how much amount is to be paid by the dealer at the time of cancellation. That we have already solved. So question number 3 answer we have already got. I have just mentioned the answer on the left hand side. So last question, it says how much is the loss or gain of the cancellation of the sale? How much is the loss or gain? Actually, what actually transaction was meant to be? It was only 50,000 GBPs. So what actual the another transaction there was? It was amounting to 50,000 of the GBPs at what price? At 92.6875. That was an extra transaction. Huh? That was an extra transaction, and for the rupees 1000 were to be subtracted from that particular case. So what will be the answer over here? So it is 50,000 into 92.6875, that is amounting to 4634375 minus the 1000. So that was the actual amount. That was the actual amount on the actual transaction. That was the extra cost. Okay, so this is the CP, we can say. It costed us rupees 4633375. That was the cost to us. And what is the selling price by us? At what we have sold the GBPs? At what price we have sold the GBPs? We have sold it at rupees 4,633,875. So what is the difference amount? It is loss of 500 rupees. It is loss of 500 rupees. Is that clear? Is that particular part clear over here? Because in the very first transaction, the 50,000 transaction related to selling the GBPs, that was an actual transaction. And further related to another 50,000 transaction, that was an extra transaction. We were to look into that particular manner because we wanted to check in the cancellation of the sale, what was the loss to us. So we had actually purchased at what price? We had actually sold at this particular price. Further, when we bought them, we just have bought them at 6575 over here, and we just get to know the differences that was related to profit or loss. And over here we are having a loss of amount rupees 500. Okay, this is related to loss because actually how it is loss? Let me tell you. Because when you have actually oversold it, it cost you 4,633,375. But when you have bought it thereafter, it cost you more. It costed you more. That is why it's a loss. That is why it's a loss over here. Okay, now let's move to the next question. Next case study. It is related to the risk-weighted assets. It is related to the risk-weighted assets, and as per the standardized approach for the credit risk, the Reserve Bank of India has provided the percentage risk weightage for different type of the loan categories. So according to that particular percentages, we need to solve this particular question. So over here, different risk percentage, different sectors we are provided with, and as per that we need to mention the percentage risk weightage, and then we will be calculating the RWA. Now let me give you an example. As in the case of the credit card receivables, the risk weightage percentage is 125%. It is 125%. Let me write it over here so that it could be clear. Okay, so it is 125%. What does it indicate? We are having the outstanding balances amounting rupees 6,400, but the risk weightage associated with the credit cards will be equal to what? It will be equal to 6,400 into 125%. That is equal to 8,000. That is equal to 8,000 over here. Is that clear? That is the risk weightage, and for each and every category, each and every sector, we will be doing the same. So what is the risk percentage weightage for the retail loans? It is 75%. It is 75%. Again, for the education loan, it is again 75%. And for the claim on schedule bank with CRAR of 11.75%, the risk percentage weightage in that case, it is 20%. it is 20%. You must have an idea related to those all. You must be having an idea related to those all. And further, let me tell you, whether it is a case of the personal loan, whether it is a case of the credit card or the consumer credit, it is 125%. It is 125% in that case. So again, it is 125% in the case of the personal loan. Further over here, in the case of the consumer credit also, it is 125% again. And in the case of the unsecured staff loans, in the case of the unsecured staff loans, it is 75%. The risk weightage is 75%. And for the housing loans, what is the percentage? What is the percentage in the case of the housing loans? What is the percentage in the case of housing loans? It is, if the LTV is given to be 80%. So here is a scenario. If in the case of the housing loans, the LTV is lesser than or equal to 80%, then the risk weightage is 35%. It is 35%. In that particular case, the risk weightage is 35%. But where the LTV is greater than 80% and up to and is up to 90%, and is up to 90%, in that case it is 50%. In that case it is 50%. So over here we are given LTV equal to 80%, which is basically permissible under 35% category. Okay, so over here we'll be taking the risk weightage percentage as 35%. We're talking about the housing loan. So here is an update related to that. Previously it was amount based, but now it is LTV based. For housing loan over here, it will be 35%. It will be 35% against the commercial real estate. If it is related to CRERH, that is against the commercial real estate residential housing. So if it is CRERH, that is commercial real estate but for residential housing, in that case it is 75%. But if it is only and only for the CRE, in that case it will be 100%. In that case it will be 100%. So over here it is 100%. Staff loan secured by the terminal benefits, whether it is basically secured by mortgage or by superannuation benefits, it will be what percentage? It will be 20%. In that case it is a 20%. Okay, and further related to consumer credit, I have already clarified you, it is 125%. For the DICGC claims, it is 0%. It is a 0% in that particular case. Further related to ECGC, it is a 20%. It is a 20%. And for the VCFs, that is for the venture capital funds, it is 150%. It is 150%. So this is how we will be calculating the risk weight assets. So just let me calculate this for you at the earliest. So it will be 6,000 into 75%, that is equal to 4,500. That is 4,500. And further for education loan, it is 4,600 plus multiply 75%, that is equal to 3,450. And the next one, it is related to claim on scheduled banks with CRAR. In that case it is 20%, so it will be equal to 1,600. And for the personal loans, it is 125%, so it will be 3,000 into 125%. 3,000 into 125%, that is 3,750. And further, in the case of the unsecured advance loans, it is 5,000 into 75%, so it will be 3,750 again. And then it is housing loan LTV 35%, so 3,000 into 35%, so it is amounting to 1,050. Further, it is related to against commercial real estate, it is 5,300 directly because it is 100%. Then staff loan, it will be 1,200 crores. Further, it will be consumer credits, it is 1,800 into 20%. 1,800 into 125%, not 20%, 125%, so it is 2,250. Further, it is related to the DICGC, it is a 0, and for the ECGC it is 300, and further 150%, so it will be equal to what? It will be equal to 3,600. Now we need to add them up all. So it is equal to 4,500 plus 3,450, 4,500 plus 3,450 plus 1,600 plus 7,500 plus 1,050 plus 8,000 plus 50, 300 plus 1200, that is 6500, plus 2250 plus 3900. So that is 38750. So the total risk weight assets over here are 38750. There is no formula related to it. You need to calculate it yourself. You need to calculate it yourself. So over here it will be total amounting. It is 3850. It is a 3850. Is it clear? Is it clear over here? Yes, there is a change related to it because related to the risk weight or asset on the consumer credit, related to consumer credit, it has been reduced to 100%. It has been reduced to 100% for the personal loans over here. For the personal loans over here, it is reduced to 100%. So it is 100% in this particular case. I'm highlighting this particular case. I'm just highlighting this particular case. So it will be 3000. So it will be 3000. So we'll be subtracting 750 from the total. So it is 38,000 in total. So it is a 38,000 in total. Okay. So it is 38,000 in total. So what will be the capital charge at 9% of risk weight asset? What is the capital charge at 9% of the risk weight asset? So it will be equal to what? It will be 38,000 multiplied by 9%, that is equal to 3420. So the capital charge would be equal to 3420 in this particular case. Is it clear? Is this particular part clear over here? So 3420 would be the answer. 3420 would be the answer. So this is for your practice only, and you must be knowing the risk weight assets related to all these sectors. Related to all these sectors, you must be having an idea related to those all. Okay. Now let's move further with another case study. So it says total risk weight assets of a bank are given to be 66600. Further, the total capital charge for the bank is given to be 9% of 666, that is 5994. Tier 1 capital for the last year is given to be 3700. Tier 1 capital for last year is given to be 3700. And further, we need to calculate we have to look into the different items of the tier 1 and tier 2 capital. And further, we need to calculate the capital risk weight asset ratio. We need to calculate the capital risk weight asset ratio. So what amount would be included from the tier 1 capitals? First of all, let us have a look at the components of the tier 1 capital. So for the paid up capital, would there be any haircut in it? Would there be any haircut in it? So there would be no haircut. So value would be used as such. So it is 1870. And in the case of the capital reserves arising out of the sale of the assets, capital reserves arising out of the sale of the assets, it will be also used as such. It will be also be used as such. So it will be 485 again. And for the IPDI, that is innovative perpetual debt instruments. Innovative perpetual debt instruments. What would be the maximum amount that can be included into a tier 1 capital? What is the maximum amount that can be included in the tier 1 capital? So it is limited to tier 1 capital of the last year. It is equal to what percentage of the last year tier 1? It is equal to the 15% of the tier 1 capital of the last year. So let me give the remarks over here. So it can be maximum up to 15% of the tier 1 capital of last year. So last year tier 1 capital over here in the question itself, it is given to be 3700. So it will be equal to what? It will be equal to 15% of 3700. So it will be equal to 15% of 3700. Let us have a look at it, what it would be. So 15% of 3700 into 15%. So it is amounting to 555. So this one is limited to what? It is limited to 555 in this particular case. And for the PNCPS and IPDA, what is the percentage ratio related to it? What is the percentage ratio related to it? So let me tell you that for the total of the IPDI, PNCPS that can be covered in the tier 1 capital, that is limited to what percentage? That is limited to 40% of the total capital. That is limited to 40% of the total capital over here. And how we can do so? How we can do calculate that particular percentage? Let us have a look at it. First of all, we will be solving the revaluation reserves. The revaluation reserves are to be taken as a part of the tier 1 capital at what discount? At 55% of the discount. At 55% of the discount, the value is to be covered in tier 1 capital. So 600 minus 55% it will be. 600 minus 55%, it is 270 in this particular case. For the revaluation reserves, it will be 270 in this particular case. And let us have a look at the excluding these two components. Excluding these two components, the total of these must be forming 60% part. It must be forming 60% part. It means what? 1870 plus 485 plus 270. That must be forming 60% part. So what is the total? It is 270 plus 485 plus 1870. The total comes out to be 2625. 2625. And 2625 is forming what percentage? It is forming 60%. It is forming the value of the 60%. Okay. So what is the total capital value of tier 1? That will be equal to 2625 divided by 60 into 100. Into 100, not 40, because we are basically focusing on calculating the total tier 1 capital. So total tier 1 capital, it will be limited to what amount? It will be limited to 4375. Let me repeat this step again over here. How did we just calculated 4375? So first of all, we wanted to calculate the value of the PNCPS IPDI. I just told you the total component of IPDI and PNCPS is limited to what percentage of tier 1? It is limited to 40% value of the tier 1. It is limited to the 40% value of the tier 1 over here. Okay. And further, I just told you that the total value we have already calculated. We have already calculated the other values, other components over here. So these three other components, which I am just marking over here. So these components over here will be forming 60% of the part. That is 1870 plus 485, that is 270. Total comes out to be 2625. That particular part will be forming 60% part, and we need to calculate the 100%, the total amount of the capital in the tier 1 capital. So that is basically multiplied by 100. That comes out to be 4375. That comes out to be 4375. So what is the maximum part of the IPDI plus PNCPS? So it is equal related to what? It will be related to what is the maximum part of the IPDI and PNCPS, that is 4375 minus 2625. That was a total of 1870 plus 485 plus 270. That was a total, that is 2625. So that is the maximum part of the IPDI plus PNCPS. So that comes out to be 4375 minus 2625. That comes out to be 1750. So here the maximum component that can be there, it can be 1750, out of which 555 is under IPDI. So from the PNCPS we can consider what percentage? From PNCPS we can consider 1750 minus 555. That is equal to 1195. So what will be the component associated with the PNCPS? It will be 1195. It will be the 1195. Are you getting this particular point over here? So it will be 1195. That will be considered under the tier 1 capital over here. Okay, I have already given the remarks related to it. Now this is total tier 1 capital. Now let us have a look at the tier 2 capital over here. So what is the maximum amount of the tier 2 capital? What is the maximum amount of tier 2 capital? Tier 2 capital can be maximum up to 100% of the tier 1 capital. It can be maximally up to 100% of the tier 1 capital. And further, over here, general provisions and total loss reserves. General provisions and loss reserves. General provisions and loss reserves. These are limited to what amount? These are limited to 1.25% of the total risk-weighted assets. These are limited to 1.25% of the total risk-weighted assets. Now the total risk-weighted assets are given to be 66600. The risk-weighted assets are given to be 66600. Okay, so 1.25% of the same. So it is 66600 multiplied by 1.25%. That comes out to be 832.5. That comes out to be 832.5. So from here, what part can be considered under general provisions and reserves? It is limited to 832.5. Okay, are you getting this particular point? And after that, it is related to hybrid debt instruments. hybrid debt capital instruments. So this amount will be considered as such. So it is equal to 500. And further related to subordinated debt, what is the limit? What is the limit related to the subordinated debt? It is limited to 50% of the tier 1 capital. The subordinate debt is limited to what? It is limited to 50% of the tier 1 capital. Now what is the amount related to tier 1 capital? It is 4375. Now its amount is limited to what? So we need to calculate the 50% of the tier 1. So 4375 into 50%, that is equal to 2187.5. So the subordinated debt amount is limited to 2187.5. I am giving narration side by side so that you can understand it well. Okay, so the subordinated amount is limited to 50% of the tier 1 over here. And further, any of the surpluses from tier 1 related to ePDF and PNCPS, that will be forming the part of the tier 2 capital. Over here, we are having ePDF equal to what? ePDF amount, it is basically 900 in this case. So 555 was utilized above. So what amount can be utilized over here in tier 2 capital? So it is 900 minus 555. So it is 345. So it is balance amount from the tier 1 capital. So 345 can be utilized under the PNCPS and under the ePDF. And under PNCPS, we were having the total amount equal to 1400, and out of it 1195 was already there in tier 1. So it is 205. So it is a 205. So any of the surpluses, any of the additional amount from the tier 1. So it is basically what amount is used over here? Additional amount. I'm just writing it over here. So additional amount is used. Okay. So what will be the total tier 2 capital we are having? What is the total tier 2 capital we are having? So we are having the total as 832.5 plus 500 plus 2187.5 plus 345 plus 205. So it is amounting to 4275. I just told you that a tier 2 capital can be maximally 100% of the tier 1 capital. So it is permissible. In this particular case, yes or no? Kindly please let me know if I'm mistaken anywhere. So the total amount, let me check the total again. So it is 832.5 plus 500 plus 2187.5 plus 345 plus 205. There was some mistake in the total, I think. So the total over here comes out to be 4070, not 4275. It is 4070. Okay. So that is amount related to the tier 1 and tier 2 capital. Now what is the question over here that you need to solve? Calculate the capital risk weight asset ratio. So what should be the formula over here? So what should be the formula that how we will be calculating the capital risk weight asset ratio? Any of the surplus from the PNCPS forms the components of the tier 2 capital. Also the RCPS, redeemable cumulative preference shares, they also form the part of the tier 2 capital. But surplus is also form the part of the tier 2 capital. So what is the formula related to the capital risk weight asset ratio? So what is the total capital amount that you have calculated? It is 4375 tier 1 capital plus the tier 2 capital 4070 divided by the total risk weight assets, that is 66600. As simple as that. So it will be 4070 plus 4375 divided by 66600, and further that comes out to be 12.68%. Is that clear? Is that particular part clear over here? So that is related to the today's case study and today's video.